Hey, welcome back to Commercial Finance Experts Academy. My name is Suo Trung, and today I want to touch base on a few acronyms I guess we call it in our commercial world. You should be familiarized with cap rate and DCR. These are very important because it will affect you in getting your financing. To understand it, what does a cap rate mean? Well, cap rate stands for capitalization rate. What it is an investment terminology that says what kind of return am I expected to get out of this investment purchase. If I'm purchasing a property that's worth, say, $1 million, if the realtor or whoever's listing it says that, or the seller is saying that the cap rate on this property is 5%. So if the cap rate is 5%, what am I expected to get out of this property? And what does it mean? Well, the cap rate formula goes NOI divided by the purchase price or the sales price equals the cap. So in this scenario, if I don't know what the NOI is, what's the net operating income is, you don't know, it stands for net operating income. That's after the taxes, that's after all the expenses for the company has been taken care of. Property management, strata, utility, all that's reduced down to what the net income is, right? So if I don't know what this is, and if I know what the sale purchase price is going to be, and this is 5% cap rate, just easy. Just take that 5% and work back with the formula. So that means it's 5% of $1 million. How much is that? It'll be guess what it is? No? You know what it is? Easy math. Go back to high school days, it gets 5%, 0.05. So 1, 2, 3, 4, a lot of 0, 0, 0, 0, 0, 0, 0, 0, 0, 6, 0. 5. And you go to the next level. Well, you know what? Easy enough. Just take the 2 decimal points. There you go. 50 grand. Is that a good return? It varies. Whatever it is, doesn't really matter. But, oh my God, I need a better eraser than this. So in the case of this, if the cap rate is 50,000, what's so important about the cap rate? Well, for an investment property, whether you can finance it or not. So based on the cap rate is the income that you take, and you use the formula called DCR, which stands for debt coverage ratio. It's just a ratio, it's a number that the lenders use to see how much you can qualify for financing. Typically they use a 1.25% ratio, meaning that if the mortgage payment was $1,000 a month in mortgage payment, you need to get $1,250 in net rent. That's simple formula, right? To getting that number will allow you to get this mortgage payment done, which will allow you to get X amount of money for the purchase. Does that make sense? Hopefully it does. I can work on a more live scenario later on my computer, perhaps do a future webinar, future video. But as far as this is why I love it. Very simple, easy to understand, and for financing purposes, these are the key points that you need to know. And in the event that the cap rate is quite low and you're unable to finance, I have a spreadsheet that automatically calculates how much they can finance based on the cap rate, right? And the interest rate, of course, too. That comes hand in hand. The one thing that I love about this is a few things. If the investment property that the investor is buying has not been fully leased, there's potentially you can get a high loan amount if you can market rent for the vacant properties. and if the area that is they're buying in has a low vacancy, chances are we can use that vacant property's income, potential income, to qualify for a higher loan amount, right? Because the potential cap rate is actually significantly higher than 5%. Why? Because once it's completely tenanted, of course the number's going to go up. And also, here's an interesting thought for you, is that if you do finance this and you get a lot of pushback from the A lender, you get it in a private money temporarily, get it completely redone, tenant increase the rent for them, renegotiate any of their month-to-month contract into long-term leases, and so that you can use a higher number. And if the property is vacant, get it tenanted or get a lease agreement in place, a letter of interest for somebody want to move into the business to lease it out. So you can use that amount of money that they're gonna lease it for. Okay. So that's one advantage of having commercial, is that you can have a short-term financing and then quickly right afterward get a lease, unlike on the residential side when it's all related with the client's issue, not necessarily the property issue, right? Most of the time, if it's a property issue, it's tough to overcome. But in commercial financing, the property issues could be easily resolved, and you can always refinance in it quickly and get an A rate. Whereas on the residential side, it's most dependent on your beacon score and credit score. On the commercial side, because it's the income from the property, if you're able to fix that income, increase it somehow, some way, chances are you get a higher loan amount and get it done at a great rate. And it's not as relevant how much the person's credit score looks like. If they got some recent R2 or 3, not a major issue, right? Late payments, as long as they don't have any long-term issues with any mortgages, they'll be fine. Okay? Hopefully you learned something from this video today. And if you have any questions, feel free to contact me at sue@sharingbanksecrets.com. And if you like this video, hit like below or comment on the comment section. Subscribe to the video if you want any future ones that comes out to you. Take care. Have a good day.